It's my pleasure now to invite, representing the Governor of the Bank of Ghana, the Director of Research, Mr. Philip Otoo, to address us. A round of applause as he comes.
It is an honor to have been invited to deliver the keynote address at the second Ghana SME and Young CEO Summit. What this forum seeks to do, and which I fully endorse, is to bring together seasoned policymakers, technocrats, business leaders, and captains of industry from around the country to deliberate and exchange ideas on some of the most contemporary issues that are central to policy formulation and the development of SMEs in the country. Let me also take this opportunity to reiterate home a point which I strongly believe in, and that is, as captains of industry, the dynamics of our economy regarding what we achieve as a nation will not only be driven by government policies, but also by what goes on in our individual boardrooms. The decisions we make in our boardrooms really do matter. Putting in place appropriate governance structures and managing risks will matter greatly in the scheme of things as our economy evolves. My agenda this morning is to speak on the current banking reforms, impact on SMEs, and economic growth. This topic is as relevant and timely at this particular point in time when the sector is going through sweeping reforms to strengthen and sanitize its operations to help support economic activity and propel economic growth to desired levels. In fact, we at the Bank of Ghana do recognize that businesses are living organisms that require constant adaptation to the evolving nature of their operations and economic circumstances in order to survive and remain competitive. Indeed, history has taught us that this fundamental belief has been the very guiding principle that has informed policy in our legal, regulatory, and institutional framework of cooperation. Let me briefly touch on the critical role of the banking sector in the economy. As you are all aware, the banking sector has been going through reforms and sanitization efforts, and in some instances, difficult decisions have had to be taken in the wider interest of our society. These choices have been made to help steer the sector clear of crisis and reshape behavior towards stability and resilience. While being the nerve center where financial activities and transactions flow to give life to the economy, the banking system remains the critical backbone of the economy and also the main supplier of credit to drive economic activity. In short, the health of the banking sector fundamentally mirrors the health of the economy, and the key channel through which that mirror imaging takes place is through efficient credit delivery. To be able to deliver this efficiently, key principal agents will be needed to assume liabilities and help transform these liabilities into good working loans to the rest of the economy. Key players in the transformational space include the banks, insurance companies, microfinance institutions, finance houses, and other such critical financial intermediaries. The health of the banks and intermediaries will always be crucial in the scheme of things to help support growth. But in order to be able to deliver on the key mandate of credit delivery, these institutions will have to operate in well-organized markets that are supported by strong infrastructural backbones. Simply put, effective interaction of intermediaries will always require well-functioning markets with solid infrastructure. The three components, sound financial intermediaries, well-functioning markets, and an efficient payment system infrastructure component are all inextricably intertwined and should work in consonance to support effective delivery of financial services. Banks need solid payment systems infrastructure to facilitate the timely processing and exchange of claims in a secure manner. A sound banking system will therefore thrive more efficiently and effectively under conditions of robust, well-functioning and efficient payment system infrastructure. Distinguished ladies and gentlemen, the need to ensure a sound banking system at the central bank is driven by the very special role banks play in national economic development. By their primary function, banks mobilize savings for investment purposes, which further generates growth and employment. The real sector, which is the productive sector of the economy, relies heavily on the banking sector for credit. Government also raises funds through the banking system to finance its developmental programs and strategic objectives. These critical roles underscore the need for ensuring a sound banking system through proactive reforms. Financial institutions need to be monitored closely because of possible systemic effects their operations could have on the broader economy. And the monitoring component to ensure stability in the banking system justifies the need for regulation. The potential for bank failures, contagion effects, panic withdrawals arising from information asymmetry on the part of economic agents, all of which could disrupt the financial system, requires strengthened supervision with appropriate tools. In fact, in these modern times, and due to the complexity of financial transactions, the norm is for central banks to engage in intrusive supervision. Now, what has been the reason for the recent reforms and drive that we have witnessed in the past year or so? The Bank of Ghana's recent banking sector reforms has been driven in large part by the pace of expansion of the economy, which provides for new opportunities. The reforms have been necessitated to strengthen the banking sector and place them in a position to help support economic activity with the ultimate goal of competing with global players in fostering international trade activities. The reforms have also been necessitated to restore confidence and inject more sanity in the banking sector. The recent state of some big banks and following their resolution has further underscored the need for constant reforms and on a regular basis. Mr. Chairman, a review of what went wrong leading to the resolution of the 7 banks highlighted certain interesting facts. Weak corporate governance structures in banks, insufficient disclosure and transparency on the financial health of banks, the existence of critical gaps in the regulatory framework and outmoded regulation, poor supervision, and weak enforcement of existing regulations all did play out in concert and push the banks to uncharted territories. The passage of the Banks and Special Deposit-Taking Institutions Act 2016 Act 930 has also provided the central bank with additional tools and an appropriate framework to deal swiftly with ailing institutions. The Act also provides an appropriate supervisory framework to enhance supervision and embark on intrusive supervision. And so, the question that arises is, what reforms have we pursued so far? I'll just list a few of them. The upward revision of the minimum capital of banks from 120 to 400 million Ghana cedis is geared towards providing for adequate buffers for the banks to deal in big ticket deals. The economy is set to expand down the road, and banks should be appropriately positioned to take care of business. A well-capitalized banking system ensures the provision of adequate buffers to support the funding of major capital projects. On a standalone or on a syndicated basis, this enables the banking system to effectively respond to the financial requirements of the real sector. Beyond the need to recapitalize the banks, recent regulatory reforms churned out by the central bank have also focused on the following. The Bank of Ghana in 2007, with technical assistance from the Office of the Superintendent of Financial Institutions in Canada, shifted from a compliance-based to a risk-based supervisory framework to ensure focus on risk profile of banks in the supervisory framework to ensure a safe and sound banking system. The central bank is currently reviewing the risk-based system framework, taking on board current developments and emerging risks, as well as expanding its coverage to the SDI sector. The central bank has also issued the banks and specialized deposit-taking institutions Corporate Governance Directive of 2018, including a draft exposure of its transitional provisions. The directive was issued in concert with the Basel Committee on Banking Supervision Guidelines. As part of our efforts to reduce the level of impaired loans in the system, the central bank has embarked on an exercise with the banks to help clean their books and remove all structural challenges that impede effective delivery of credit. The central bank is enforcing its directive on loan write-offs and will require appropriate disclosure of written-off facilities in the published financial statements of banks. We have also issued the financial directive of Pillar 1 of Basel II and 3 capital regime. This was after the draft directive was issued to banks for their comments and feedback, and industry was engaged extensively to address all concerns. The central bank is now at the parallel run stage in the implementation process, and full compliance will be enforced by January 1, 2019. We are also currently working on requirement under Pillar 2 of the Basel Accord to strengthen the supervisory review process. This will involve internal capital adequacy assessment processes, which allows banks to undertake an assessment of their own capital commensurate with all their risk exposures. We are also driving disclosure requirements in conformity with Pillar 3 of the Basel Accord to enhance appropriate information flow to market participants. The guide for financial publication is presently under review, and a revised version will be released before end December 2018 to ensure that annual accounts of banks are in line with the requirements and expectations of the central bank. The revised guideline has taken into account the requirements of IFRS 9 and other disclosures necessary to give the general public a holistic view of all the risks that banks face. The process of implementing the BSDI Act 2016 Act 930 through guideline legislation is in progress, and the central bank is currently reviewing existing directives and regulations to align them with the Act. At the same time, we are developing new directives for issuance to the industry. In line with this, we have issued draft exposures for comments relating to the Fit and Proper Directive, financial holding companies, voluntary winding up, as well as directives on mergers and acquisitions. Impact of the reforms. The current banking reforms are yielding positive results. Let me share some few progress. The reforms are gradually changing the way business is conducted. Banks are now bracing themselves to adopt best practices in the areas of corporate governance and risk management, and this should help in the way forward. Transparency and public disclosure requirements of transactions are now becoming the norm. Profitability and earning levels are gradually improving, as evidenced in financial statements of a number of banks. The industry remains generally solvent, and capital adequacy levels are increasing as banks brace themselves in an effort to raise their capital levels by the end of the year, and also put in measures in reducing their risk-weighted assets. Non-performing loans are being structured and will be reduced over time. Corporate governance structures are also being put in place to ensure quality capacity at the top of most of these institutions. Mr. Chairman, the Central Bank is confident that the banking landscape and way of conducting business will not be the same following completion of recapitalization efforts and bank efforts to instill new corporate governance structures. Before I conclude, allow me to make a very key point regarding how I see the evolution of banking. As I went through the selected topics for the panel discussion, a key segment struck me, and this is the segment on technology panel. Digital innovations are fast changing the way of life of many of the companies in the country, and this offers an immense opportunity for both banks and SMEs to exploit to the fullest maximum for economic gains. As digitization takes hold, most firms, including SMEs, will embrace this concept to affect their business models. And the traditional way of doing business is slowly giving way to digital trading, and this is shifting away the conduct of business into new territories. SMEs in this respect will have to strategically re-engineer and rethink their mode of operations, address their digital strategy objectives, and deliver a better customer experience to ensure competitiveness and to enhance efficiency of operations. The banking sector will also have to adapt to these changing times and exploit the opportunities that are being presented by digitization. Banks must be in a position to adapt to these customer habits, competition, technologies, and solutions preferred in the digital space. And this is where the challenge in the banking industry will be observed in the coming years. Banks and financial institutions, including the intermediaries, will have to brace themselves and rethink their operations going forward. The central bank, on its part, is looking at the whole digitization revolution currently emerging, and we are putting in place structures and thinking through policies and regulations to drive the entire process. In conclusion, ladies and gentlemen, the banking sector occupies and will continue to occupy a vital position in the economy and must be subject to continuous reforms to allow for effective functioning. The modest achievements so far will be jealously guarded, and going forward, the central bank would require greater collaboration and commitment on the part of all stakeholders to support effective implementation of policies and embrace evolutionary changes in the horizon. Let me reiterate that the Bank of Ghana remains deeply committed to its mandate of ensuring the safety and soundness of the banking sector. We are absolutely confident that these measures, working through the various policies and regulations being pushed, will make our banking system more resilient and contribute to the overall growth of the economy. Thank you very much for your kind attention, and let me wish you fruitful deliberations. Thank you.